An investment holding and management company Invicta has reported its operating profit down by 3% to just over R1 billion. In the studio in Johannesburg is the CEO, Charles Walters. Charles, I'm trying to find this quote that I was reading out earlier on to our market commentator. I've just found it here. These were some of the worst trading conditions we have experienced in many years. What you're saying is probably the worst ever.
Certainly in the time that I can recall, Lindsay, yes, and good afternoon to you. Very, very challenging. Industrial action from platinum strikes to the heavy strike that the engineering sector took in July, followed by the lack of rain and the drought that we've had in the country, which has affected the agricultural economy of the country quite a bit. And then, of course, out in Asia, things are tough there too, with the global slowdown in mining activity and resource activity affecting places like Indonesia and Malaysia, and the quite significant slowdown in construction activity in China. So a combination of multiple negatives, and that's why we are so pleased with the results that we have been able to produce in the period.
Yeah, those results are as follows. Turnover flat at 10.5 billion. Operating profit was down 3% to just over 1 billion. And earnings attributable to ordinary shareholders flat at 579 million. So I suppose you've got to say to yourself that despite the fact that people are used to better stuff from Invicta when it comes to these interim and full year results, yeah, it's respectable. Can we start with the various sectors and start with engineering consumables, go on to capital equipment and then to building supplies? Tell us the highs and the lows of the period under review, if you would.
Certainly. We were very pleased with the BMG result in particular. I think the guys came through incredibly strongly with very, very tough conditions, showing revenue growth and operating profit growth and holding their margins at the revenue growth and operating profit growth at 6% and holding margin at a very respectable 12% operating margin. The building supplies group also managed to show growth in a rather more buoyant DIY and construction sector into housing, although off a low base. And the disappointment, although relative disappointment, was the capital equipment group, which the revenue was down there 10% and the operating profit only down 6%, which is a fine result actually when you consider the trading conditions in the more cyclical sector of capital equipment.
Let's talk about the Asian part of your business, because I remember talking to your predecessor, and it was an exciting investment, and it did very well for a while, but also has stalled, which is slightly disturbing because it was almost a hedge against South Africa's stalling environment.
Yeah, Lindsay, we're certainly very pleased with it. We didn't buy it for a 2 or 3 year return. It has done well relative to market. I mean, a lot of their competitors are in fact loss-making, where they are still very healthily in the black. It's a spare parts business, which does make it more defensive than a true capital equipment business, but we do report it under our capital equipment segment. And we're actively pushing the parts growth in that business, and both in South Africa and in Asia, to hedge the cyclicality of original equipment sales. But we've also, since purchasing it, seen a 30% odd devaluation in the rand against the Sing dollar. We recently, in fact, in this reporting period, took out the 25% minorities. By agreement, we took them out early, and that reduced the minority interest in the group. And so that shows that we're very confident we've got a good business here, trading through some very tough conditions, and it is still providing that rand hedge component.
Yes, indeed. So when things do turn around, you'll be well placed to take advantage of that in South Africa and in Singapore. Thanks so much for your time this lunchtime, Charles. That's Charles Walters, who's the CEO of Invicta.